Some people might squirrel away cash in their sock drawer or mattress, or even a freezer if you just moved to the big city. But most people keep the bulk of their hard-earned money in either savings or checking accounts. All of these have the same issue, however. They don't do anything to protect you from inflation. Welcome to the Just Dumb Enough podcast, a show that acknowledges no one is always an expert by dispelling misconceptions with real experts. I'm your host as always, Colton Petrie. My guest today is Andrew Parrillo. Andrew is an investment advisor with about 5 decades of experience, and while this episode shouldn't be considered advice for legal reasons, it is absolutely chock full of invaluable information. Because we're going to break down really technical details, it can get a little dry, but make no mistake, I understand money and investing more from this interview than probably any other I've done. Don't be afraid to take notes if you've got a free hand, otherwise you might miss out on nuggets like this.
And you pay an advisor 1% a year to invest that money, so you're getting 6% after the fee. The difference in the value after 20 years is over $300,000. It's actually $332,000.
Let's make money by saving money. Welcome to the show, Andrew Parrillo.
Thanks, Colton. I appreciate it. I'm grateful to be here. I didn't think I'd have this opportunity, to deliver my message, but I do. So thank you.
Yeah, and thank you so much for being here. I'm so excited to talk to you. Why don't you introduce yourself a little bit for the people listening?
Okay. Andrew Parrillo. I don't want to start from day one. That would take too long. I've been around for a while. But now I got in the investment business a little bit by accident. When I got off active duty from the Air Force, I went to work as a trainee at a bank, and I was identified by one of the people there as someone who had promise in the investment department. So they put me in the investment department, and I did pretty well there. And I moved on to one of the larger banks in the state of Rhode Island. That's where I was from. And so at age 32, I was managing the largest investment department of that bank, which was the largest bank in the state, and dealing with the bank's biggest clients and, on the investment committee. And so I thought I did pretty well. And then a few years later, I had the opportunity to to really focus my attention on investing, and I moved to a firm in Boston, and that led to a few positions. And then in 1995, I formed my own firm, and so and I did so because I thought I could make a difference in the way business was done in that industry, and using essentially full disclosure on everything, which was lacking in the industry, in my estimation. And so I did. And I was fortunate and charmed, I guess, to have gotten referrals. Clients that I had came with me. I didn't solicit them. They came with me. And I started a firm in a super competitive industry. And, it was really not unlike a startup going up against some of the biggest firms that exist today. And that's what I did. And I didn't need to be big or have lots of people or, that sort of thing. I just wanted to do a good job for the clients I had. And so that's what I did, where institutions tend to have the same kinds of portfolios. Endowments were known to be more creative and, were willing to do things a bit differently to generate higher returns. And their time horizons were very long-term. In fact, they were perpetual. And it's really hard to think about investing perpetually. We're immortal. We're not going to be here forever. But those institutions are going to be here for a long time. And so they have a long-term view. And so that really is the foundation of their perspective, is a long-term view. And having said that, some of them could take a little more what we normally would consider risk, investment risk. And let me talk about risk. What's investment risk? Well, it's losing all your money. It's not achieving what you want to achieve. Perhaps the biggest risk anybody could take in life is not taking risk. And why would anybody take risk with their money when they could put it in a bank and have insured money? Well, institutions couldn't because they had assets that far exceeded the insurance levels of a bank. They could invest in short-term government securities, which are very safe in our world. And we'll talk about that a bit, perhaps. But in order to do better than inflation, they have to take risk. So that's the enemy. Why do we have to invest? Well, we don't have to invest, but if we want to maintain the purchasing power of our money in the future, we have to assume some risk.
Why the risk? Where does it come from?
All right, let's talk about that. In our country, the Federal Reserve System was formed in 1913, and it was created by Congress to regulate the amount of money in circulation and also to regulate credit. Up to that time, different banks were issuing their own currency, believe it or not, and there was really no credit regulation. So there were speculative periods, as there have been throughout history. There are speculative periods, and why are there speculative periods? It's because human behavior is such that it fluctuates between fear and greed when it comes to investing, and it's very important to understand that. And in fact, entire studies have been done, on behavioral finance, and we'll talk about that as well. And it's very important to understand that. But anyway, so the Federal Reserve started in 1913. They issued the US dollar. Well, that dollar today, because of inflation, only buys 1 penny's worth of goods. And the other thing I could say throughout this talk is I would invite your audience to just go to the internet and look at inflation calculators. They're inflation calculators, and you can put the year in and the amount of money and what it would be worth today if you started out whatever year you want to start, a year ago, 10 years ago, 100, whatever. But so for that, from 1913 till now, it's gone down to a penny. What happened, though, in the meantime, is it really didn't decline that much in value until the U.S. went off, suspended convertibility to gold. And President Nixon in 1971 suspended convertibility of the U.S. dollar into gold by foreign central banks, because up till that point, a bank in another country, a central bank, a government-controlled bank, could turn its dollars in and get gold in return. Well, we didn't have enough gold to satisfy those requests, so Nixon suspended convertibility in August of 1971. And since that time, the value of the dollar has gone down such that it only buys about 10 cents of what it did in 1971. Now, that 1971 is probably long before many of your audience was even born, but my point is that it's been inflation just in the last 10 years has gone down by 30%, a little over 31%. Since COVID in 2020, it's down by about 21% in value. So inflation, and we confront inflation every day. We see it at the grocery store. We see it everywhere we go. We see it at the price of everything we buy. And we know what's happened since COVID with supply chain issues have exacerbated price increases. And it's starting to moderate a little bit now, we've seen. But that doesn't mean prices have gone down. It just means that they haven't gone up quite as fast.
So when we hear inflation, what do we do?
So what does that mean? Well, it affects all of us. And and I don't care if you're a billionaire or you're just starting in the working community and trying to save money or support yourself. It affects us. So what can you do? Well, it's easy for me to say we should save money, okay? And that gets down to it's kind of a theory and time preference. Do you want to save money now or do you want to spend money now? Well, most people know that if they save for the future, they will at least have something to lean on in the future. And the more they save, the more they'll have in the future. Also, the more they save and invest, the more they'll have in the future. And that's what this whole retirement planning idea is about. And it's easy for people to put it off. But the biggest problem with investing is not starting. So if you want to protect the value of your money in time, and again, in the last 10 years, it cost $1.32 to buy what a dollar did 10 years ago. Okay. If you invested it in the stock market, you would have more than doubled your money in the last 10 years. Yeah, but the stock market involves risk. Why don't I just go to an insurance company or a bank? Well, you could do that, but you have to understand you're not going to get the same return that you could take by assuming some risk in the stock market.
And what exactly is the stock market?
Well, the stock market represents an interest in, a call on, if you will, the financial success of companies, of which you own a piece in what is called stock or equity securities, or you own a piece of a company. And I don't have to name the companies. We all know the major companies. But so what does that mean? Well, what it means is you can buy those shares of those companies, and they could go up or go down, or they could go to zero. Okay, companies will fail and have failed and will fail. So from an investment standpoint, you want to do things that are a little more predictable. And you may want to take some risk at the margin by buying something that you think will go up a lot, and and it may, or it may go to zero. But as long as you calibrate it so that if it does go to zero, you're not going to destroy your whole program.
So, what are some wise or prudent investments?
So let's talk about what are prudent investments. Well, I mean, it's widely accepted that diversification is more prudent than concentrating positions. Well, one way to diversify for very little fee is to invest in an index fund. And the most popular index is the Standard & Poor's 500. Well, there are broad market indices too, but we can get into that. But for now, let's talk about the Standard. The Standard & Poor's 500 stock composite index is constructed by the Standard & Poor's Corporation. It selects those 500 companies or so. Sometimes it's 500, sometimes it's a little more, a little less, but it's basically 500 companies. And they've been doing that since 1926, so it's almost 100 years. And those are all domestically based companies that it deems to have the financial strength and prospects that are worthy of investing. And that doesn't mean they always get it right, because some of those companies don't, do very well. And things do change. And we've seen that. We've seen it in, recently. You see how companies can fall out of favor and fail or underperform. And General Electric is sort of the big example in the last 25 years, where 25 years ago, people thought GE was the absolute pinnacle of success in companies. And within 10, 15 years, it really kind of became a shadow of its former self. And now it's all broken up into different parts. And sure, it's a great company. Parts of it are great company. But my point is that things do change. So companies come in and out of favor. Amazon didn't even exist, 30 years ago. Well, maybe it did exist just 30 years ago. But now it's, we know what it is and we know how it benefits our lives. And those kinds of changes will continue to be made. And they will be reflected in the Standard & Poor's 500 stock index, which is a measure of corporate performance over 100 years. All right, what does that measure mean? Well, it's generated a total rate of return, which includes the dividends that are paid by those companies. And companies can pay dividends quarterly if they have sufficient capital and sufficient profitability. Not all companies pay dividends, but most of them do. And so with dividends reinvested, including the price of the stock, the S&P 500, the Standard & Poor's 500, has generated approximately a 10% return for 100 years. It's generated approximately a 10% return for the last 50 years, which coincides with that convertibility of gold thing I was talking about a moment ago. But it declines too. We get bear markets too, don't we? Yes, we do. And during the Depression years in the 30s, the stock market went down for 85% over a 3-year period. So your dollar was worth 15 cents. Well, that was pretty scary. But if you held on, it came back. And so over time, you would have made that 10% a year. If you got frightened and you sold out at the bottom and you didn't participate in the recovery, which did occur, then you lost.
To stay sharp and not lose, I recommend Magic Mind. They're these killer little mental performance shots that only ever took up about 5 seconds of my daily routine. The problem is that I've come to really enjoy the high-grade matcha, and my taste buds were feeling a bit neglected. So I reached out and they informed me how easy it is to just throw one of these shots in with some iced milk. Now I get to enjoy that flavor for a full hour before the deep regret of already having finished my drink kicks in. It's all thanks to these little wonder drinks that I even have enough focus to do interviews like this one. The energy is smooth with no shakes, jitters, or crashes to be seen, and thanks to the various very smart scientists on their team dreaming up things like nano encapsulation, the effects take hold up to 10 times faster. That's more energy and focus to be my dumb self without worrying about the anxiety or stress of the everyday world. Get in on this slice of nirvana by going to www.magicmind.com/justdumb20 or by entering the code justdumb20 for up to 48% off your first subscription or 20% off any order. That's JUSTDUMB20. But what's the message we take from these losses in the market?
So what's the message there? Well, the message there is to stay invested for the long term. That's really not very easy to do for most people. And let's talk about how we manage that. So even in the last 10 years or so, the stock markets in 2022, the stock market was down about 18%. And the bond market was down too at the same time, about 15, 16%, depending on the maturity of bonds you own. But they were both down, call it 20%. And of course, it came back. When the COVID crisis hit in March or February of 2020, the stock market went down by 35% in 30 days. Wow. And it frightened a lot of people. The stock market, many people remember the great financial crisis that hit really pretty hard starting in September of 2008 when Lehman Brothers failed and the whole financial system was in peril and was rescued. And it went down it actually started going down in October of 2007. And it went down from October 2007, October 2008, until March 9th of 2009. So what's that, about a year and a half? So in that year and a half, it went down about 50%. Now, that's a terrifying decline for most people, to see their money go from $1 to 50 cents in a year and a half and stay down. And what was scary about that is that when the stock market recovered in March of 2009, and it never looked back really when it started that recovery after that 50+% decline from the great financial crisis, the economy looked terrible. Everything looked terrible, but the stock market somehow discounted. We call it discounting. The stock market discounted the improvement in the economy and the market, and it came back. Well, some of us remember the dot-com crash that started in March of 2000. And that went on from March of 2000, March of 2001, March of 2002, and it didn't recover until October of 2002. So that was like 2.5 years of decline of 50%. And some companies went to zero, and companies like, that I mentioned earlier, Amazon, I mean, they went down a lot, and I won't cite percentages because I don't want to say anything wrong, but they went down a lot. And we know what's happened since then. They've recovered. So the message there is that invest for the long term has been a wise decision, but it's a decision that you have to be resolute to execute, because if you invest in stocks, they will go down in value at some point. They may go down a lot, and they may stay down for a long time. And if you need that money when they're down, then you're kind of in trouble. Then maybe you do have to sell some, but by no means should you sell anything more than what you absolutely need to take out of that account, because what's going to happen is it will come back. And I have been in the business literally since that August of 1971. Okay, so I've seen this real time. I've experienced it with real clients, and I've seen how they've reacted to market declines. And it's usually with trepidation, or sometimes they're terrified. And I can say that's true for endowment boards and trustees and individuals as well. But I was, in most cases, not in every case, but in most cases, I was able to convince people to please stay the course, stay invested, and you will recover. And they did. And they did. In fact, we'll do what we call rebalancing when we can talk about that too in a bit. But if you have questions about that, it gets a little more technical, but it's something that people can understand. The other thing that's happened, and as I talk about this stuff, everything I'm talking about is available on most of the major investment firms' websites. And it's available for no cost and no obligation. Okay, so it's not threatening. And does that mean you won't get a call from somebody trying to sell you? No, it doesn't. You will get those calls. And, I happen to respect people who try to sell me things that could be valuable. So I listen, but you don't have to listen. You can ignore them. But the fact is that all those resources are available for little or no cost and no obligation. And calculators are available for little or no cost. So if I put X percentage in the S&P 500 and Y percentage in, say, a safer investment like treasuries, government securities or treasury bills, what will it do? Well, you can get those answers. But basically, the typical allocation that people use to stocks is not 100% of their money. But over time, it turns out that the best allocation has been 100% of your money in stocks. Absolutely. Except it doesn't leave you with any liquidity reserve if things go sideways. And so everybody, from a financial planning standpoint, should probably talk to a financial planner, certified financial planner, or their CPA, or there are many resources online if you don't want to spend any money on it at all, and you can get good advice. And that's one of the things that has changed in the last 20 years that was not the case. And I wrote a book called Beat the Wealth Management Hustle. And what is that? Well, Wall Street has maintained its legacy approach to the world, and it hasn't changed its fee structure. You can buy stocks for no commissions now. That was not the case 40 years ago, it cost 50 cents or more a share to buy a share of stock. Now it doesn't cost anything. And so that's a good thing. But the investment advisory business continues to charge pretty high fees on an ongoing basis. And if they add value above what you could make yourself by investing in an index, that's wonderful. And you should do it. But if they don't, you should at least understand that they don't. You may be more comfortable staying with an investment advisor because you like the person, you trust them, you think their firm is good and honest and ethical and smart and skillful and so forth. But all I would say is there are questions that you should ask. Basic due diligence questions. How much do you charge? What do I get for after the fee for on my money? Or what have I gotten? What should I expect to get? And they may not be able to tell you that, which is they cannot make projections about the future beyond just general statements as I'm making. But you should at least understand on an ongoing basis what they have made for you. And they should be reporting what they've done net of their fees compared to the market and compared to your portfolio, comparing your portfolio to an index, composite index of returns that mirrors your portfolio. So you can judge whether or not they've added value. And it's a really straightforward process. Every investment advisor should be happy to do that. And if they're not, that should tell you that maybe you should find one that is. And that's basically my message. It's straightforward that you can over time, you've been able to enhance the purchasing power of your money by assuming some risk. You have to calibrate that risk to your own preferences. And my book talks about that extensively. Investing should not be intimidating to people. And the industry really does confuse people on that point. And the day-to-day financial news is confusing. It's confusing to professionals, much less to those who are not looking at it constantly and making their living, doing investment advisory work. And I understand. And you could think of the stock markets as being more of a fashion place. Now, recently we've seen the so-called meme stocks do well in the last week or so. Now, they did very well right after COVID, and people made tons of money with, I won't name the brokers, but you could find them, and it doesn't cost anything to do it. And there's low minimum amounts for investing. You just understand that, that certainly involves risk. As long as you know what it is, that's great. And you can do well, but you have to calibrate, the risk that you can take with your capital carefully, and don't get overextended. And it can get good investing, skillful investing, or just even the S&P 500. It turns out, so you might say, well, wait a minute, you're saying the S&P 500 is a good place to go. Over time, it has been, and it's generated net of fees, after fees. It's generated competitive rates of return to those that are, when you compare those to managed accounts. And let's talk about fees for a second. Fees are super important. And I talked to Colton a bit earlier about this. And if you can do the math, and you can do it with calculators on the internet pretty easily, but just do the math on some numbers. And one of the example in my book is, and this is not for everybody because not that many people have this, but call it on $500,000. If you invested at 7% for 20 years, and you pay an advisor 1% a year to invest that money, so you're getting 6% after the fee. The difference in the value after 20 years is over $300,000. It's actually $332,000. And you could get that you could get that return of 7% for little or no fee, historically, with less than 100% in stocks, frankly. And so, is it worth $300,000 to you over 20 years to do that? Is the question. Or are you willing to pay somebody $330,000 to manage your money and only get less than you could get on your own? That's the question. And you say, well, 1%. Well, that's not much. 1% is nothing. Well, just remember that Einstein, who I think we all would agree is probably a pretty smart dude, said that compound interest is the eighth wonder of the world. And he was right. Oh, and the other thing, long as I'm kind of quoting some well-known people, there's a guy who's not an investment guy who probably has given the best investment advice ever, and is Mike Tyson, the boxer. And Mike Tyson said, everybody's got a plan till they get punched in the mouth. And you will know if you're an investor, you're going to get punched in the mouth, but you have to be willing to execute your plan. And don't ever forget what Mike Tyson said, because that's probably the best investment lesson I could give you is to have a plan and be resolute and be resilient and see it through. And this is a guy that gets up at 3 a.m. and trains and has done so ever since he was a teenager. And look where it's gotten, and he's, but the point is that execute your plan because you will be tested. You absolutely will be tested. And that's pretty much the message that I have to deliver. It's I'd be happy to take any questions that you might have on it. And I might have missed some things, but I think I covered it all.
Well, I mean, there's a certain amount, like you said, everybody's got a plan until they get punched in the face. That's the panic, right? Like you see the numbers dip and you're like, oh, I got to bail out now. And you're like, look, the average over time says you'll make money. Don't worry about it. You're going to make your money. Just hold out. Your plan is to basically stay here. So don't worry about it. It requires no movement. Don't panic.
Well, there's a familiar temptation that most of us have, and that is to go with what our gut says feels good. And it might feel good to think that you can get out of the market and then get back in after it goes down. But it's a really hard thing to actually do. You might be able to do it successfully once or twice, maybe. But the most successful investors, long-term investors, at least institutional investors, do not try to time their exposure to the stock market. And we did a study at my firm and we updated it regularly, but this study only went from 1961 to 2017. But in that time, Treasury bills, U.S. Treasury bills, 3-month bills, or they're actually 91-day bills, 3-month, they were widely called 3-month bills, did 5% a year. The S&P 500 did about 9.8% a year during that whole period from 61 to 17. If you miss just 4% of the best months in that period of time, in that 50 years, you would have had, well, it was more than 50 years, but you would have had a return of less than Treasury bills. Miss 4% of the best months, you would have had a return of less than Treasury bills. And as a practical matter, what happens to people is they'll generally get out after the stock market goes down, and they won't get back in at the bottom. They'll get back in after it goes up. And if you miss those up moves, you might as well have just stayed in Treasury bills, or which is another way. Or another way of saying that is the stock market most of the time, 96% of the time, at least over that period from 1961 to 2017. All of its gain above 5% was generated in less than 4% of the months. So most of the time, it doesn't do anything relative to Treasury bills. It goes sideways, it goes down, it goes up, it goes down. It doesn't do anything. But where it really makes its big moves is only a very small percentage. And if you can pick the best 4% of the months, you're really doing well. And in all the work that I've done, and I spent a career interviewing some of the smartest hedge fund managers in the world, I've only met a few people who were skillful at market timing. So why doesn't everybody invest with them? Because they don't accept everybody's money. They have a limit on what they will accept. And oh, by the way, they charge a lot of money to do it. They don't always do it well. And you might be, you might hire them, and the next 5 years they're terrible, and the 5 years after that they're spectacular. But it's hard to calibrate that. And so it's really hard to find those skillful investors. They are out there. I'm not saying they aren't out there. They are out there, but it's hard to find them. The other thing you could do is, if you're looking at mutual funds, and all this information is publicly available through the brokerage firms and for free, you look at what the mutual funds charge. And although the costs of management on mutual funds has come down a lot, some of them still charge way more than 1% a year. Some are 2% or more a year for the specialized funds. And then if you look at their performance compared to whatever you want to compare it to, and you could do that again for no cost on their sites, you'll see that it hasn't measured up. So why are you paying them all that money for a nice report, for an articulate manager that you see on television every once in a while? Oh, that brings up another subject. I've seen interviews of people on the popular financial programs whom I know and whose actual performance I actually know. And when they get on these programs, they're usually not legally allowed to talk about their performance. They can't discuss it. They can't disclose it. They can't say really what they own. They can't say really what what their performance has been. but I happen to have known it because I happen to know them and I did research on their firms for years in some cases. And why they're on those shows is way beyond me, because in many cases, they really don't have very good performance, to put it kindly. But, they have them on the shows and they talk, oh, yeah, the market's going to do this, and the market's going to do that, and the Fed's going to do this, and the Fed's going to do that. Well, okay, what's your track record of predictions? And they don't ever disclose that, of course, because they say, well, I can't legally disclose it, which they can't. So it's this kind of goofy dynamic, that and I don't want to sound cynical, although I am a bit skeptical about this, circumspect, let's call it. But the TV shows want to get viewers. And how do you get viewers but to get something on that's interesting and exciting for the moment? And so they have picks to click. They want something to happen right now, and it could, but you might want to try it. But I would just say, if you do not understand something, don't do it. If you don't understand what a company does, don't invest in its stock. It doesn't mean the stock won't go up if you don't understand it, but it doesn't care whether you know or not. The market doesn't care what you know. The market is the market. The market is the arbiter. And so, the same thing is true for any strategy. If you don't understand it, don't do it. And all I'm laying out there is, it's a simple one. It turns out that the simplest strategy is the least costly and one of the most competitive strategies you could execute. And that doesn't sound right, but it's true. The other thing that people don't quite get when they turn their money over to an investment advisor is they're saying, okay, Mr. or Ms. Advisor, I'm going to start paying you money to take risk with my money. What? Yeah, I'm going to pay you money to take risk with my. Well, I will take risk with your money, but, I'll consider your circumstances and your goals and your objectives and your tolerance for risk. But the bottom line is they're taking risk with your money and you're paying them to do it. You have to really think about that one. Because the last thing you want to do, you have to know your tolerance for investment risk before you exceed it. You have to understand that. And you have to know that you will be tested. You will probably get to that limit. And you have to know, what am I going to do when I get to that limit? You have to know that before you get there. It's like when you're driving somewhere, you don't want to have a full tank. You don't want to have 400 miles of gas in your car. And, at 450 miles or 399 miles, figure, I only got another mile left and there's no gas station within 50 miles. You can't do that. Yeah. So you got to know, you got to plan ahead. And I'm throwing I'm not a doctor, I'm not a PhD, I'm not, and so many people in the world of, what we're in with they're doctors or they're PhDs. So it's Dr. Smith or Dr. Jones or Dr. Okay, what are you a doctor of? It's like, yeah. Okay. I mean, okay, but that's not me. I'm just a regular person that has a lot of real experience that I want to share with people that I think will benefit them. And am I selling something? Well, I guess ultimately I am selling something. I'm selling my book. I'm selling possibly a course. I do have a firm, and it's not for everybody, frankly. It's for people with money to invest and who want to do so efficiently. I mean, if somebody says, what do you do? I help people invest their money efficiently. That's what I do. I would suggest to people they invest their money the most efficient way possible. I mean, if somebody's going to be put off by that, well, I'm sorry. I don't know what to. Am I selling something? Well, yeah, you could do it for zero cost, or you could get more involved. And yes, it could involve some expenditure. As long as you know what you're getting, you know what you're paying, and you know what you're getting. And that's where Wall Street is really tricky. They make it so that people think they're getting something, and they're not quite sure what they're paying, and they're not quite sure what they're getting, but they think they're getting something because they see these advertisements and they see these big firms, and it's a branding thing, and that's fine. If they know that, that's great. As long as they know it, make your choice, And so I'm just about clarity, and I want to be an ambassador of clarity. So I want to.
But yeah, I mean, that's like the nature of the show, right? When I do the intro, I'm talking about like, we're addressing misconceptions with experts. Because like you said, a lot of this is like Wall Street marketing says you have to do it this way. And you're like, that's not accurate. And a lot of banks would be like, well, just put your money in this account. And you're like, that's not good either. So, we address small misconceptions, but it's things that people hear every day and just don't, they don't investigate it because you trust what you hear. And we just don't live in that age anymore.
There's a lot of stuff on the internet that just is not, credible.
Yeah.
That people say a lot of things that just don't turn out to be true. They make a lot of promises that they can't keep, or, not that they don't want to, but that they can't keep. And it's almost, to me, it's become, sorry to say it, because it's become a waste of time and
Yeah.
energy. And since I published the book, and I spent most of the last year until January, December, actually writing the book. So I'm trying to promote it and looking at social media and talking to different consultants, paying a lot of money that was totally wasted money. I mean, it was wasted time as much as wasted money. It was wasted time. But it's like anything else. You can't believe everything you read.
Right.
And sometimes you can't even believe everything you think. So so my bottom line is the internet's kind of been a waste. So if I were to do something where I wanted to gain an audience, I have no idea how to do it. I'd like to benefit people with what I know, which I think again is simple, and everybody should know about it, and everybody should be, if they're not investing, they should be. And the good news is, and I don't know if you read my book, the good news is there's no minimum and there's no fee required. You can just, as long as you understand, if you keep your money in a savings account, probably going to go down in value. You're not going to be able to buy as much, a few years from now as you could buy with it today. But if you want to be able to do that, you're going to have to assume some risk. Well, what does that mean? Well, you have to be able to manage it. You have to understand what that is. And so that's my shtick, basically, is let's look at history. Let's see what's going on. Let's understand ourselves, and then understand what happens in the world and finance. And we can navigate through it. And we do so with competitive returns for little or no fee. I mean, that's really the message. And it's what Warren Buffett's been saying for 50 years. It's not nothing new to me, but it has, and I'll explain this once we get into this podcast, but the world has changed a lot in the last 10 and 20 years. And we didn't have Amazon 25 years ago. And most people, when we first go, oh, there's no way I'm putting my credit card information on the internet. It's going to be stolen. It'll be hacked. And yeah, that has happened. It still happens, especially now with AI and stuff. It'll happen. But, but people use it. It's a value. It provides a service. It's created its own demand. Mobile telephones, or the iPhone in 2007, created its own demand. And now most of us depend on it. And so technology has changed the world. One thing that has not changed is the Wall Street legacy approach to the world and how they extract money from people. And it's not like I'm some kind of bomb thrower up against Wall Street. Although Wall Street would hate my message, of course. But it's the fact, it's the truth. And the world has changed, but Wall Street hasn't changed its approach. And that's what my forward writer said in his foreword. That's what I say in the book. But it's time for a change. So let's open the gates, like open the curtains, and show people what's really going on out there. And yeah, they can do it. They can benefit. They could, and so, yeah.
That's kind of the big numbers in here, right? Is like, inflation is going to affect people regardless. And when we're talking like, from 1970, if you had $1 million, $1 million would buy you basically anything. You could get a house essentially anywhere without a problem. Cut to, 2020, and it's like you still have $1 million, which is still sounds really nice, but it's only worth a tenth of what it used to be. Right? And so you're like, well, you could buy a house, but definitely not anywhere. It's going to be nice in some places. It's not going to be nice in others. And that's just from holding on to your money, from doing nothing with it. Like it's suddenly, worth less because of inflation versus like, putting your money into something, you're now growing it, or at least trying to outperform inflation so your buying power doesn't go down in the long run.
That's exactly right. And, there was an article I saw this morning about the house prices are up something like 50% over the last 4 years. And what's interesting is for a decade, after the great financial crisis, there was considerable overbuilding. And people might remember the subprime loan situation that caused the great financial crisis. And it's where people were buying houses with no ability to pay for them, essentially. And mortgages, so-called subprime mortgages were being put out. And they were only 6% of the total mortgage market at the time. But the failure of that market was enough to crash the economy and to crash the housing market. So what happened was, for an entire decade, from about 2008 through just recently, really, actually it was probably 2020, there was no housing built. And what happened is then the demand started to come in after COVID for housing, and the prices skyrocketed. So for a long time, the price of houses really didn't change at all. And for most of the, and that's what the thing is, like, people are thinking that, well, it's because of this president or that president, that no, what happened was there was overbuilding up until 2007, and then there was no demand, which crashed because of the great financial crisis. And then banks started tightening up on mortgage lending. They didn't loan, and their standards were much higher, and people couldn't get mortgages, and they didn't buy houses. And so there was a surplus of houses for years, but that got soaked up right around COVID. And so we see prices have gone up 50% or so, and just in 4 years. And so it happens that this inflation it's pernicious, it's harmful, it's not like it happens a little bit every day. It'll be quiescent, or it'll be, calm for a while, and then for a period of time, it'll just shoot up. Now, I experienced this earlier in my life when I was just getting started and having a family, and inflation was rampant, and interest rates were 14, 15% on mortgages, which people can't even imagine, because many people have 2 or 3% mortgages from a few years ago. They don't have them now because they're like 6 or 7% now. Which is still historically not that high, but compared to what it was a few years earlier, it's double, and that's like $1,000 a month on an average house in extra mortgage payments, and that's a lot of money. And it happens sporadically, but it's been persistent, and it's been persistent, quite frankly, through history. It just hasn't been at the rate that it's been at in the last 10 years through history. As long as, and I could get into why that happens, or why is the dollar worth less? So, well, it's because there are a lot more of them around, a lot more dollars around now, because the Federal Reserve System, which prints money, literally, it creates money out of thin air to finance the economy, or to help the economy stay lubricated, if you will, stay liquid. But as long as we have the system that we have, we're probably going to have inflation. We're probably going to have monetary growth. And what does that mean? Well, it means that the government gets to pay back its debts in inflated dollars. So it gets to pay back, with less money, basically. Now, we have $34 trillion in government debt right now, which has doubled in the last, 7 or 8 years, which is pretty scary. And that's a real problem. But, are the politicians going to solve that? I hope so. You can be your own judge about that one, but I don't know that politicians are going to do anything different from what they've done in the past. And I hate to talk about that, really, because I'm not taking one side or another. I'm just saying that that's what's happened. And in a democracy, and where that could, well, the other thing, and we could, and your audience probably has some questions about Bitcoin, and I'm quite familiar with that as it happens. And it is a finite situation. It's really not a commodity. It has a finite supply, unlike every other commodity, including gold. And so it's a speculative asset for sure, but it's one that has been the best performing asset in the last 15 years by a lot. So, and there's a small section in my book about it, but you should educate yourself on the subject. And I would say that there's a big difference between Bitcoin and every other cryptocurrency. There's a significant difference, and people should educate themselves to understand what that is. And I'm not suggesting one way or the other that they do anything, buy it or short it, or you could ignore it if you want. But it is alleged by many people to be an answer to the creation of money by central banks. And we've seen countries like Argentina, Venezuela, Lebanon, and others fail because their central banks have just printed money that became worthless. And history of 100 years ago tells us in the Weimar Republic in Germany, they printed so much money that people would have wheelbarrows full of currency to buy a loaf of bread, and literally wheelbarrows full. And that was in a very short period of time. In a year or two, it went from being worth something to being worth nothing. And I'm not saying that's going to happen to the dollar. It's a more slow motion thing here, but it's happening. So the dollar in 1913 buys a penny today. And it takes a lot of pennies to buy a loaf of bread today.
Yes, it does.
right? I mean, I'm not advocating for Bitcoin, but I'm saying that people should understand that that's one reason that people might be interested in owning it or have been interested in owning it. And who knows, maybe it goes to zero, and maybe the politicians who are against it are right, but what they're doing is they're saying, we like the banking system the way it is, and, we want to keep that in place. And so that gets to be a political conversation, which I don't want to get into, but if you just look at what's out there, that is what's out there. So
Yeah.
I would
When
invite anybody to, engage me in any kind of conversation about that anytime. Happy to do it. If I can benefit people's financial futures, I would like to do that. I've been around for quite a while. I've been through it. I've seen it. And it's super important to me to alert people to the importance of doing it.
Certainly, well, especially, when you're talking about just the amount you'd pay in advisory funds if you had, and, we say like $500,000, but divide that by 10. Like, what if you have $50,000? Well, you're still paying, what, 32,000 in investments. It's the same thing. Like, you just divide the number down to where you're at. And it's like, would you pay somebody $32,000 to manage your $50,000? Like, well,
Exactly. That's right.
no, I'd never do that. That's
Right.
crazy.
Yeah. But that's what Wall Street has persuaded people to do. And it's, to me, I mean, I would say it's not fully disclosing what it's doing. It's not putting it into context, and it's not transparent. And the other thing that people should know about investment management fees, if they do talk to an advisor, is by regulation, the Securities and Exchange Commission requires managers to be willing to negotiate their fees. That doesn't mean that they'll lower them, but they have to be willing to negotiate. And they won't tell you that. So, these fees are negotiable. Well, their documents and their disclosure statements will say that somewhere in the print, but you have to read the print. But I'm just telling them they're negotiable. Everything's negotiable. Will they lower the fees? Maybe. Probably will. Will they lower them enough to make a difference? Maybe. But have them prove it to you.
Well, and that's, people I think are so conflict averse that they're like, well, I don't want to argue with them. Like, I'm just going to let them do this. It's like, well, you're doing a disservice to yourself because if you just, a half minute of uncomfortability where you just say, like, well, I don't want to pay that, make it lower. And they say, okay, sure. That's a very short conversation that'll save you a lot of money in the long run, even if you do choose to have somebody else managing it.
Absolutely. I mean, was your money? Any question's a fair question. Any question. You can ask them anything. Nothing's illegal. You can ask them any question you want. Well, obviously, there's some things that are illegal, I guess, but you could, when it was with respect to your money, you can ask them any question you want.
Well, and those should be like, red flag moments if they're not willing to answer questions or they kind of, divert their answer to not really address what you just asked. Like, you probably shouldn't trust them with your money because you wouldn't do that, if I was like trying to sell you something physical in my hand, but I wouldn't answer questions about it, like you wouldn't buy it.
Well, the other thing I found is, and this happened to somebody who's very close to me, they read my book and they said, wow, that's really, well, it was one of my sons. And he decided that he was going to release his advisor. We looked at, and the portfolio was a perfectly conventional looking portfolio. It had a dozen or 12 different constituents in it. It kind of had a little bit of everything, a little bit of all different kinds of funds. They were in ETFs mostly, except for one fund that was a higher cost fund, but it was a specialized fund. And I understand that. I can understand that. But the bottom line of it is that after their fees, all those different constituents and all those, small cap growth and small cap value and international stocks and emerging markets, etc. It was all very interesting, and I understand the fundamental reasons for every one of them. But what was the bottom line? The bottom line over a decade is they didn't do as well as the S&P 500, that whole portfolio, and particularly after their fees. So it's like, what am I doing this for? So he stopped. And it's funny, I've met a couple of people who have read the book or who say, you're absolutely right. And I did that a few years ago. All I'm doing is suggesting what Warren Buffett's been telling people to do for 50 years. Or the guy that started Vanguard, John Bogle, the same thing he's been saying for 50 years. It's not rocket science, and you don't have to be intimidated by it. And you can do it for very, very low cost and do it with my book, yeah, it's funny. My editor, I wrote my book and I just sat down, I started writing. And I just wrote about what I experienced in my career, and which I've talked about a lot about here. Not everything, but a lot about stuff here on this podcast. What I suggested to my editor was a title of the book called Invest with Joy and Peace of Mind. And what financial person has ever used the word joy? Ever. And what I advocate is that's exactly, people should be investing certainly with peace of mind, and they should try to do everything they can to reduce or eliminate any anxiety they might have with the approach that I've described. But they should do it with joy. Think about it. We are so fortunate to be able to have the country that we have, to be free to save, to be free to do so many things that other people in the world are not free to do. We should rejoice in that and be joyful about the opportunity to invest and save for ourselves and our family, our loved ones, for the future. And we shouldn't be fearful. What's the alternative to being joyful? Being fearful, I think. That's the opposite. Being concerned, being anxious. You don't want to spend your life being anxious about your money. You don't want to spend your time being fearful. No, what I'm suggesting is be joyful and know in that joy that, yeah, you're going to be tested. Yeah, you're going to get punched in the mouth. You will, but you're going to overcome it. And that's another reason to celebrate. As you've overcome it, you've prevailed. And that's assuming history will repeat itself. There's no guarantee that happens. One of the things I did not say is there's a difference between uncertainty and risk. We can measure investment risk. You can't measure uncertainty. And how can we measure investment risk? Because there's a pattern that's repeated itself over 100 years, okay, of human behavior. And investment and the stock market is nothing more than a reflection of people's expectations of the future. What is that? That's their behavior. So people's behavior is reflected in the prices of stocks and the performance of the S&P 500. And so that can be modeled and that can be projected. Is it perfect? No. It's only a probability study, but you can assess probabilities to certain outcomes, and that's risk measurement. Whereas uncertainty is, oh my goodness, anything could happen. But, people might think about investing as the difference between Armageddon and Nirvana. And we're never going to we haven't had Armageddon. We haven't had Nirvana. Probably not going to get to either one of those extremes, right? but something in between. And some of us worry about things that are never, the more things can happen than will happen. And most of us, if we think about those things about which we've been worrying in the past, how many of them have actually come true? And you have to answer that yourself. But in my life, I've worried about a whole lot of things that have never come true. And I do it almost every day, to be honest. And, I have to say, no, shouldn't do that. Don't do that. It's not the way to be. Try to look at it the other way around. Anyway, that's a little bit of my philosophy.
Certainly. Well, I mean, thank you for coming on the show and for, spreading this information. I want to make sure we say the name of your book and where we can find it if people are looking for it.
Yes, it's Beat the Wealth Management Hustle. Invest independently to grow savings faster with peace of mind is the subtitle. And the foreword is written by a pretty well-known financier whose name is Anthony Scaramucci, who's frequently on these shows that I mentioned, but who more recently has spent his time talking about political matters. He had been in the Trump White House. He's recently written his own book about from Wall Street to the White House and back. And Anthony's a friend, and he wrote the foreword. So anyway, but the book is on Amazon and at the other booksellers and Barnes and Noble and so forth. Beat the Wealth Management Hustle, Andrew Parrillo, and yeah.
Fantastic. There will be links to that in the description if people are looking for an easy way to find it. And as I always tell people, if you pick up these books, please leave good reviews for them because that's how other people find them, right? The algorithm is not designed to be like, well, it sells really well, so let's show it. They're like, no, it's could sell extremely well, but it doesn't get any good reviews and no one finds it. And that's, not fair if you enjoyed something and found benefit in it.
Wow, Colton, so awesome. Thank you for saying that. I mean, I just wrote the book to express what I learned in my career and to try to benefit people. I didn't think about promoting it or getting it reviewed or selling it but I really appreciate what you're saying because I do think it's something that people should know. And for what it's worth, a friend of mine who is now retired but was a 25-year editor at the Wall Street Journal, he said, why hasn't this book been published before? And I said, Richard, I don't really know, but it's kind of anti-Wall Street. Maybe that's why it hasn't been published. But it's something that people should know about. So I really appreciate your saying that. Thank you.
Yeah, of course. No, it's just your book has too much common sense, and it's it's too disruptive for that.
It's disruptive. I hope it's clear. As I said earlier, I want to be an ambassador of clarity. I don't want to be, people should not be confused by the jargon of the business. It's a lot of, they don't need it. It's just simple.
Yeah,
Just keep it simple, guys.
of course. Well, thank you again so much for being here.
My pleasure. Thank you so much, Colton.
It's wild to think that 1% could make such a difference, but even paying that 1% to gain an additional 5% a year would be well worth it versus a savings account that earns you $1 a year or less. In other news, July is upon us and the rankings are all new. Number 1, the United States, now led by Texas, Illinois, and Virginia. Number 2, Canada, with Ontario taking an early lead. Number 3, Australia, with Victoria just barely holding out over New South Wales and Queensland. Number 4, Ghana, who have quickly found themselves a top 5 regular. And number 5, England, almost losing their spot to Ireland. Special thanks to Magic Mind for their continued support of this show and my new Japanese ceremonial grade matcha cravings. Get yours at magicmind.com/justdumb20 or by entering that code justdumb20 for up to 48% off your first subscription or 20% off your order. That's JUSTDUMB20. And that's it for this week. Have a great week, a great weekend, and I'll see you all back here next week for another new episode. Until that next episode, pretty please do all those things that help the show grow, like rating, reviewing, liking, and subscribing. Remember, you can reach out to dumbenoughpodcast@gmail.com or on any of the social medias if you want to reach me personally. But most importantly, stay dumb.